the second video, we are going to talk about financial treatment and the metrics used for inventory. Inventory is you record it as an asset. So if you want to find out inventory information about businesses, you need to go to the annual report, the balance sheet. Under balance sheet, look for assets, look for current assets under that, and then you should see the inventory here as General Motors data is pointing it out. Well, besides that, some businesses, based on the accounting standards and the disclosure policies, sometimes give you more information about the different types of inventory. One thing here, since inventory is recorded as an asset, sometimes inventory gets unsellable, like in the case of Cisco that we saw in previous video. So in that case, it has to be expensed off. But what we see is expenses office creates a reduction of profits. So business leaders may not be as um, tenable to reduce or write off inventories, and sometimes unsellable inventories continue to get carried on as assets. But anyways, one problem of measuring inventories with absolute values like this inventory values that you see here is larger companies would obviously have more inventories and smaller companies would have less. So ideal is to measure inventory in some form of ratio, and one ratio which is very much used is called inventory turns, which is called cost of goods sold divided by average inventory. Here the assumption is that the inventory is valued as per its cost. So cost of goods sold and average inventory both are measured in the same terms of cost. Just to understand how this COGI inventory turns works, let's take two scenarios. Scenario one is an ice cream truck goes out in the morning, purchases ice cream worth $60, sells it off by the end of the day for $100. So the cost of goods sold, we'll assume the business has no other expense, is $60, and the average inventory, they start with $60 worth of inventory, end with $0 worth of inventory, all the ice cream is sold off. So their average inventory is 30 because 60 plus 0 divided by 2. A second model for this business could be that they go to the morning, buy ice cream worth $30, and then sell it off by noon, go back to the market, buy ice cream for $30 again, sell it off by $50. They still have bought ice cream for $60, so their COGS is still 60, but their average inventory is now 15 because they bought inventory worth 30, sold it off to make it 0. So 30 plus 0 divided by 2. So that's how their average inventory works. So the difference here is the first business made $40. Their inventory turns were 2, as we saw. But and they need $60 to run the business because every morning they need to go to the market and buy $60 worth of ice cream, assuming they pay by cash. So they need $60 to run the business. Versus the second business has the same profit of $40 and they only need $30 to do the business because they buy $30 worth of ice cream, make $50, pay $30 from that, and again sell it for $50. So inventory turns is a measure of the cash needed or the working capital needed to run the business. This decision of how much working capital should be invested to run the business or how much inventory turn should I have is generally based on these three parameters. Customer service. Well, if I have a business where I want to give more customer service, I never want to run out of materials, I have to carry higher inventory. Higher inventory means higher average inventory. It means lower inventory turns. Some other businesses have very high margins. So because they have high margins, they want to give in higher service, and then they would want to carry, they are okay with higher working capital and cost of higher inventory, and they would have lower inventory turns. Some other businesses have very high perishability. And because they have high perishability, they would want to carry a lower inventory and lower inventory, so they should have higher turns. Businesses selling perishable products should have higher turns. Remember these 3 points. I'm going to ask you to make some judgments in a little bit. Another way of measuring inventory is this very intuitive number called inventory days. It tells you how many days of inventory you are carrying. Again, some General Motor numbers. So they had finished goods inventory of $5,118 million, and I've calculated the finished goods inventory days. So for 2021, they carried 19.14 days of inventory. So even if they stop producing, theoretically, they can still sell for the 19 more days. That's what we are talking about. So that's why this ratio is very intuitive and very easy to understand. Generally, the inventory days is not measured on past COGS but future COGS. What's the expected COGS in the future? So, that actually gives me a very good idea of how long that the inventory that I have is going to be sufficient for. So, if I have 15 days of raw material inventory, I know that I am covered for the next 15 days and I need to start planning to get more inventory after some time. So that's how this inventory days are going to be useful. So if you have realized this, we will go into this data that I have collected for 4 retailers. I want you to pause this video a bit and think of it, given those 3 factors of margins, customer service, and perishability. Who do you expect to have higher inventory turns of higher inventory days? And who do you expect to have lower inventory turns in given what you know about inventory? So pause the video, make some assumptions, and I will come back to the calculations in a few seconds. So if you have guessed, let's make the calculations and see how good your guesses are. So the inventory turns is equal to COGS divided by average inventory. This is the average inventory. This is what the inventory turns is. And my inventory days is average inventory divided by, sorry, I need to put a parentheses here, divided by the COGS times 365 days in the year. This gives me, so their inventory is sufficient to last them for 41 days. I copy this formula and paste it here. I don't like this error sign, so I'm going to select this error sign and say ignore error. And it did not ignore error for the first entry. And then I'm going to copy these numbers for the other retailers. Gives me error again, but I'm going to ignore that. And now what we see is Macy's, which talks about higher customer service and higher margins, has the lowest inventory turns. Because which makes sense. So they want to have carry higher inventory and they're in fashion. We need to give more choices. Walmart, which carries a lot of grocery item, has higher inventory turns and their margins are also very lower. So they can't carry a higher amount of inventory. And Dollar Tree at this part, they actually can't afford inventory. Their margins should be low. But what they have is they only sell products which are non-perishable. So even though they're carrying inventory, they are going to eventually sell that inventory sometime. So Dollar Tree knows, well, they have to buy goods from a distant location. When you buy from distant location, my inventory goes up. And I can't afford that inventory. So what I do is ensure that all my inventory is non-perishable. So that's how Dollar Tree can survive in spite of having lower inventory terms. I leave it to you to judge the COVID effect, but this is the idea of inventory turns and inventory days. Let's go back and look at some other metrics. So some other metrics are this idea of fill rates, which are measured inventory from the customer service viewpoint. So let's assume a business has these 5 orders. I've created dummy order numbers and they sell 5 items. So order number 120 FR that I have here, the first order, wants 3 items. They sell 4 items, I'm sorry. Item number 2, item number 3, and item number 4. So order 120 FR has 3 line items, line item 2, 3, 4. The last order 03 MW, 032 MW has only 2 line items. And order number 365 LC has all 5 line items which are part of the order. So when I say line items, try to imagine that the order, purchase order would have, or the sales order would have three lines, 4 lines, or so many lines, each item being a line. So one way to measure how good your inventory management is to say item fill rate. So in all, if I total up all the items that are ordered, 167 items were 191 items were ordered and 167 were satisfied. So the item fill rate is 0.87. Another is how many line items. If I total, the first order has 3 line items, second order has 4 line items, and third order has 3 line items. If I total that up, I have 16 line items which were ordered, out of which 12 were satisfied. You can see the 4 not satisfied items here. In this, you would probably, if you find out, for example, line item 1 in 365 LC is not satisfied, line item 1 in 122 FR is not satisfied, and so on. 4 are unsatisfied. So line item fill rate is 0.75. Another way to look at this is order fill rate. We have five orders, out of which 2 orders, I think they are order number um, 1, which is 120 FR, and the order number um, it's 40067 KP. Those are the orders which are fully satisfied. All other orders are not fully satisfied. So we create an order fill rate of 2 out of 5, which is 0.40. So again, here the idea is you can have many different type of fill rates. Have companies talk about case fill rate, companies talk about pallet fill rate, but the whole idea is depending on your business model, depending on your unit of shipping, and what's important for your consumer, you create these fill rates. So what we saw here was two fill rates, two types of inventory metrics. One measuring from the point of view of inventory performance, which was the inventory days or inventory turns, and second from the view of customer service, which is these different fill rates. In the next video, we will take this discussion ahead and talk about inventory and